Good evening. Good evening, John.
That was underwhelming. Good evening, everybody.
Good evening.
We're gonna go ahead and get started. If you haven't had a chance to sample the food that's been brought in, please just politely get up and go and try it and bring it back to your seat, please. We've got two different speakers tonight covering our broad topic of small business finance. We're going to lead off with my fellow colleague in the SBDC, the Small Business Development Center, Brenda Sanchez from the Tukwila office, a prior auditor with the Department of Revenue. She's going to take us through basic accounting. So Brenda Lease, take it away.
Prior you are. Do we have a mic?
Oh, I think it's on the behind you.
Yes. Okay. Can you see me? It's not the best. Test, test. Can you hear me? Is that better? Awesome. Awesome. Okay, so before I get started, I want to do a disclaimer. SBDC, we are not allowed to give legal advice. Every business is different, so your particular tax situation would be, it's better suited if you ask specific questions to an accountant, your own accountant, or a tax attorney, some kind of attorney. So getting that out of the way, before I get started, actually, does anyone know the difference between bookkeeping and accounting? Anyone?
Bookkeeping is basically your balance sheet, just making sure your expenses are recorded in the right way. Accounting is the bigger picture. Bookkeeping probably the part of accounting, if I'm not mistaken.
Yeah, you're close. So bookkeeping is basically the record keeping of your business, of your accounting records, your finances. That's just keeping the records, someone writing down all your transactions. The accounting part is the interpretation of those records. So basically, well, that's the difference between the two. A lot of people get those mixed up. So when you think of a bookkeeper, think of someone doing data entry. And when you think of an accountant, think of someone interpreting your books, creating balance sheets, creating financial statements, doing your taxes, more in depth of those records. Really important to notice, if you don't have your bookkeeping right, your accounting is going to be perfect. It's not going to be worth the paper it's printed on. So you want to make sure that you're being consistent with your bookkeeping, so that your accounting, your financial statements, all of that information is correct. Okay. So the first thing you want to consider with your small business accounting is the type of accounting you're going to do, whether it's cash or accrual. The difference between the two, the best way to explain it is cash is anytime there's a transaction happening, money coming in, money going out, that's basically cash accounting. Accrual is when it's either earned or you owe it, whether if money changes hands or not. So a good example is you invoice a customer and you're not paid yet. Technically, under accrual accounting, you've made that income. And then you make adjustments later on, like your bad debts, things like that. But that's the first decision you have to make when you're thinking about bookkeeping, or you're thinking about your accounting records, is whether if you're going to do a cash or accrual. At the end of the day, if you're using a software like an accounting software, they always have an option for either one. You can either do cash or accrual. Business owners, you typically like cash because it's actually money changing hands and it's a lot easier to keep track of. Accrual is more of an accountant's favorite thing because it's just more complicated. Anyway, so here's a good example of the difference between cash accounting and accrual accounting. So under let's see. So here we have a florist. Let's see, actually, does someone want to volunteer to read? That's probably better. Thank you, ma'am. I love your flowers. You're welcome.
Previous slide. I missed it.
Yes. Just wait. No, stop right there. Okay. So see, under cash, the expense would be recorded on the 25th because that's when she paid the invoice. Versus accrual, it would be the 5th because that's when she accrued that expense. Does that make sense? Okay. Same thing for income. So here, I believe everyone has a copy of the presentation as well, right?
No.
No?
That's great.
Only the handouts. Only the handouts. Okay. Well, I can send that to Sue and well, here. And I can hand out my business card if you guys have questions after the fact. So here it's the same kind of example, only it's with income. So to keep things timely, I'll just breeze through here. So basically, here we have someone that received, let's see, received an order. Okay, the completed orders on the 9th, the delivery schedule on the 7th. They send an invoice, on the 9th for 700. They receive payment on the 14th. So under cash, it would be recorded on the 14th, but on accrual, it would be recorded on the 9th. So it's basically the same thing, whether it's income or expense. Does anyone have questions on that?
So,
Yeah.
is there a benefit? Because it feels like you can say it's done, but it's still gonna get that money.
Yeah. So it kind of depends on your industry and if you have an accountant. That's why I say here with cash versus accrual, nowadays it really doesn't matter because your accounting system will be able, like, let's say you have QuickBooks, right? You will be able to pull up your financial statements, whether it's cash or accrual, but you have to make sure that you click that button, whether it's cash or accrual. If you're working with an accountant, most likely you have accrual accounting. But you can ask that question to your accountant themselves, if you have someone doing it.
Is there a benefit to your service business, or why would you do accrual if?
So some people pick accrual because let's say you have year-end expenses or, whatever, and you want to pay all of those expenses. Let's say you're gonna take advantage of them next year and you want to play that year-end game. That's a lot of people pick accrual because of that, but you have to be consistent. If you pick cash, you have to stick with cash. If you pick accrual, you have to stick with accrual. You can't wait till the year end and then pick something different just because you're playing that game. Because what happens is everything's going to be thrown off. Your income's going to be thrown off and your expenses is going to be thrown off. So don't play like. If you pick one and then later on you decide that you want to change to something else, then you have to do a change in it's called an accounting change. So you basically have to make those adjustments whether between that cash and accrual. Does that make sense? Okay.
Yeah.
And I think we had another question. Yeah.
Which method is a sort of standard, like
Standard for the
yeah, like one of the to get less income and more expenses.
Well, you're gonna have income and expenses no matter when you report it, but an industry standard is a.
Okay.
Yeah.
And is that gap?
Yes, gap accounting would be accrual accounting. Yep. Okay. Other questions? So now, okay, so here is where a lot of business owners get tripped up, whether it's single entry or double entry. So single entry, a lot of business owners that don't understand accounting, they'll do single entry, have QuickBooks as an accounting system, and then try to pull out financial statements, and then all the numbers are messed up. And the reason being is that single entry accounting or single entry record keeping, let me fix that, single entry record keeping, it's basically, let's say you bought, I don't know, a car or something, and you pay cash, like a used car, and you pay cash for it, you pay $5,000 or whatever. With single entry, you're only recording that money going out and then the vehicle coming in, but you're not recording everything else that should be in your accounting system. So it's like, I have an example here. That's probably better. Okay. Anyway, let me get back to that. But single entry is not recording the entire financial picture. The double entry, again, accountants and CPAs are more familiar with this, but double entry accounting, you want to have double entry accounting because this is where your financial, you can pull financial statements from. So you can have, your balance sheet's gonna make sense. You're gonna be able to have an income statement. You're gonna be able to have a cash flow statement. When you use single entry, you're just not entering transactions into your accounting system that are gonna flow to these different financial statements. So, a good example would be, let's say you have, let's say you're a bakery and you buy, flour, sugar, whatever, vanilla, whatever that is. So that's your raw materials. And then you, let's say you have cupcakes in your store and they're just sitting there, they haven't been sold yet. Well, that's still in inventory. That's not part of cost of goods sold. And what single entry accounting doesn't do for you is that it doesn't account for your inventory. So you won't be able to keep track of that. So double entry, you'll be able to keep track of your inventory. And if anyone has physical products or any kind of inventory, you understand that can be a pain in the butt to keep track of if you're not keeping track of it. So, okay, so that's single and double. Okay, and here's my example I was thinking about. So here we have an example, let's say it's a building loan, right? So you're only recording that expense. And you notice that it's just one line, and that's why it's called single entry. Here we have double, right? We have the mortgage, we have the building fund, and then we have our debits and credits. And here is flowing your assets and liabilities. Bonus points to who knows assets and liabilities. What financial statement is that on? Does anyone know? Good job. Yes, balance sheet. So you notice that this is not here. You have your income and expenses, but you don't have your assets and liabilities. So this is why double entry accounting, it's industry standard, and all of the accounting software that you're going to come in contact with is going to have double entry accounting. So if you're looking at your books and records and your financial statements aren't making sense, and things are not appearing there, I would start with this. I would look at how you're reporting your transactions. Okay, chart of accounts. This is important to your doing double entry for your accounting, because that's where all of these accounts come in. So you'll have each of these accounts, each of these funds or accounts will have their own individual account number. And if your chart of accounts is set up correctly, like versus like will be grouped together. Let's say you have all of your, I don't know, let me go back there. Let's say you have all of your accounts, all of your liability accounts would be all 500, and all of your income accounts would be 600. I'm just throwing numbers out there, but it also helps whoever's doing the transactions in your system catch things quicker, because you're like, they will be able to see, oh, this is recorded under 500 accounts, this doesn't make sense, whatever. But that's basically the chart of accounts is just a list of all of the accounts you have in your accounting system. And you'll, whoever's doing the transactions or putting the transactions into your accounting system will be able to catch that a lot quicker when you're doing, whether it's monthly, quarterly, however you reconcile your books and records. Okay, so trial balance. A lot of people don't use the trial balance. They'll just do reconciliations. It's kind of like, I'd say older school. But the trial balance is basically reconciling the transactions you have in your system. Yeah, your debits and credits. It's a worksheet that you reconcile your debits and credits before you get to your financial statement. So it's kind of like a checklist, check sheet, whatever you want to call it. This is when you pull a trial balance, which any accounting system you have will have something for a trial. You would be able to pull a trial balance, and you can reconcile that with your accounts. You can reconcile that with your bank statements, and that a lot of times when you pull that spreadsheet when you pull that worksheet, you'll be able to see things like, you'll be able to see those accounts I was talking about, and you'll see red flags before you look at your financial statement. So I recommend doing a trial balance, or at least doing that reconciliation on a monthly basis, and you'll be able to find red flags a lot quicker before you start thinking, oh, what's going on with my business, blah, blah, blah. Yeah, so that's the trial balance. Okay, so now we're at financial statements. We have our balance sheet, our profit and loss, and our cash flow statement. Okay, so the balance sheet. So here we look at this formula here. We have our assets, both current and non-current. So current, it's also called long-term assets. Anything that's over a year would be considered non-current or long-term assets. And we have our liabilities. Current liability, same thing. A year or less would be current. Non-current long-term would be a year or more. And then this is a plug number, so it would be, what is it? Assets equals liabilities plus shareholders' equity. Other people call it, I believe, it's like net worth. It's basically the net worth of your business. So that's what would be recorded on your balance sheet. Your profit and loss statement. A lot of people are more familiar with this because that's your income, your revenue, your expenses, and your profit and loss. Here, oh, it's also called statement of operation. You know, does anyone have questions on the balance sheet or the profit and loss? Yeah.
So just to clarify, assets is the same as inventory? I mean, or
Assets-
inventory is a part of assets.
Yes, assets are,
But it's
yes,
more than that.
inventory is a part of assets. Think of assets as anything that makes your business money. Yeah, and liabilities would be like your business and, sorry, not your business. Your building, your vehicles, your equipment that depreciates over time. No, wait, equipment will be. I'm sorry, I'm like really nervous. Sorry, guys. Okay, so statement of cash flows. A lot of people don't pull this from their accounting system, but I suggest you do, because you look at 3 different things that you can do with your cash in your business. You have your operating activities, which is basically, you know, what you normally do with your business, how you generate income. Your investing activities would be anything that your business obviously invests in, like if you have any other income, like side projects with your business, anything that's not ordinary for your business. Financing activities, this is basically like loans, liabilities. Think of just things taking money out of your business, then that would be fine. Well, actually, money coming into your business from your own pocket, like if you're investing into your business, that would be financing, not investing. So investing would be anything your business is doing, anything your business is investing. And then financing would be your loans, basically how your business is getting money versus operating. Like, yeah, that's it. Any questions on statement of cash flows? Yes.
So the investment activity, would that include buying equipment and stuff like that, or, supplies like, I'm not sure I understand what you mean by the business.
Sure. So, okay, so think about, give me an example. What's your business?
So, here's the item.
Gifts and items, okay. So gifts and items would fall under your operating activities because it's anything normal and usual for your business. Anything that falls under investing activities would be if you branch out to something else, like if you, if you go and you purchase another business, that's like a service business or something like that, that would be an investing activity, right? Because it's not normal and usual for your business. So think of operating as anything normal, usual. If you have, I keep going to the bakery example, but if you have a bakery, you know, your cakes, equipment, your ovens, your, all that stuff. Let's say you're buying, if you buy another bakery, it would be part of this because you're expanding. But investing would be something not normal and usual for your business. Does that clarify?
Yeah.
Yes. Any other questions? All right. Now, so here's some common bookkeeping systems. They're called accounting systems, same thing. Well, same kind of thing. QuickBooks is the most popular. I would. Is there anyone just starting out? Lots of people. Awesome. I think. Okay, believe it or not, I had one audit, that this lady was in business for like 20 years, never been audited. She didn't even have an accounting system. She just had a bunch of receipts and I can't even. So, but that does not mean that you can't get started on the right foot. And the reason why I ask if anyone's just starting is I know, and I'm not promoting these guys, I'm just telling you that Wave Financial, I think it's known by Wave Apps. You're able to do free invoicing. They just charge you like fees for, like transactions, like credit cards or debit cards, things like that. And then I believe all of these others are only paid. So if you're just starting out, especially if you have like a service business, it's probably a good idea, but always search, do Google search. That's your friend. Yes, ma'am.
I'm using that spreadsheet in Excel. Is useful. You make your tables in Excel.
You can do all of your accounting in your spreadsheet. However, keep in mind that you also have to take those records, those transactions you're doing in spreadsheets, and then translate that into your balance sheet, your income statement, and your cash flow. The advantage of using software is that when you put in a transaction, it automatically, since you're categorizing it and you have your chart of accounts, it automatically puts it into your financials. So you can do spreadsheets. That is another option, especially for people starting out. But know that that's going to be a lot more manual and it's going to take a lot more time. Okay. Oh, sorry. Yes, ma'am.
Do we have to save our receipts? Because mine tend to fade. So what I do, I have QuickBooks, and so I have it linked to my business account. So I always use my card when I'm buying stuff for the business. So would I need to save my receipts? Because those transactions are automatically transferred over to QuickBooks.
You always have your bank statements, like your credit card statements, bank statements, things like that. If you want to keep track of what you use that money for, then yes. So like, let's say you're buying a whole list of I don't know, inventory.
Like I go to the chef store sometimes.
Yeah.
So I have all of those, and right now they're
Yeah.
like fading away. I have a envelope full, like, took them out and said, well,
Well,
heck.
there's apps and things like that where you can take pictures of the receipts. I'm thinking of one, and I can't think of the name right now, but there are apps that you can take pictures of the receipts and it works as a scanner. Before the ink and everything goes away, and it saves you a lot of paper, a lot of space.
Well, QuickBooks actually connects, if you have QuickBooks and download the app and take a picture of your receipt, it will connect it to the appropriate transaction that goes through your bank.
So that's an option.
Oh, okay.
What did you say? So she said that, well, were you asking about the question or what? Oh, what she just said. She was saying that with QuickBooks, you can take a picture of the receipt and it'll automatically do the transaction for you.
Yeah, no, it will wait, like, for example, you have the list of your transactions, everything you bought it before. And then you take a picture of that receipt and it will have the receipt, and we'll just flip it to it, so all of the information is in your QuickBooks account, if you ever get audited before.
I do recommend double checking the transaction because sometimes it
It
can't.
doesn't
yeah.
make you double check it, you have to approve it, like, it is there and all your receipts are there, but you have to approve the connection to the.
So there you go. That's good. That's an option as well. Thank you. Let's see, reports and budgets. So I was talking about doing a monthly, quarterly, reconciliation of your books and records. So these are two reports that I want to point out that are really important. Is your AR aging and your AP. So basically, AR aging is your accounts receivable. That's accounts that you have or that your customers have with you that they haven't paid you yet. So you can pull up this report and it'll tell you 30, 60, 90 days. A lot of times business owners get busy and they fall behind in getting the money coming in. So you want to stay on top of your accounts receivable aging. Your AP aging, that's money that your business owes maybe vendors or other people. So AP accounts payable, AR accounts receivable. So you want to be pulling up these reports, just making sure that your business is tracking with money coming in and money going out. And then as an accountant, I highly suggest having a budget. You don't have to have one, but it helps you see where the numbers are, like what you think your business should be doing and what your business is actually doing. And it helps you project a lot easier when you're keeping track of that on a regular basis. So yeah, so that's what I want. Any questions about that? Oh, yes, sir.
I don't know if it's about this, but let's say you just been running your business and you haven't kept track of anything at all. What is the next step?
Sure. So the next step is just start. How do you eat an elephant? A little bit at, a bite at a time, right? So just start keeping track of it, and then I mean it's hard to say when a business owner has time to go back. But at least if you start today keeping track of those things, you know that going forward, you'll be on the right track, on the right path. Anyone else? Yes, sir.
How often should I be pulling these reports? It's just like every.
I would say every month. So typically, accountants like to do the month-end processing. So like, the end of the month, you get to the end of the month, and then that first week after the end of the month, that's when you should be doing your bank reconciliations, like checking, make sure that there's no any bad transactions, making sure that what's in your accounting system is actually correct instead of waiting to year end. A lot of business owners wait till the year end and they're like, oh my God, this is so impossible. Well, doing that on a monthly basis, it keeps your books and records clean, and it keeps your sanity because you know exactly what's happening in your business. Does that answer your question? Anyone else? No? So next we have. Okay, so here I touched on briefly that inventory, right? So you wanna monitor your inventory, you wanna see, this is important for two reasons. One, you wanna know how old is your inventory, how much, what's the turnaround on your inventory, how quickly you're selling your inventory as you're getting it. What's another one? Sales by offering. You can do this, like, if you have, sales by offering would be if you have different services, different products. You can check and see which are your most, profitable products and promote those, right? P&L by customer. That is, I would say that's a very important report to do if you have an accounting system, because that'll tell you who are your problem customers. Who should you be kicking to the curb? And who you should be like promoting more to, right? So time, energy, and money, right? That's something that's really short for small businesses. You want to be focusing on those customers that are going to be profitable for you, that are not going to be a pain in the butt, and just, yeah, and another reason why you want to keep track of that is possibly finding more customers of the more profitable ones that you have, if that makes sense. So like how you found this one profitable customer, let's say you went to an event or something like that, and then you know where to find them. Any questions?
What is P&L for?
Oh, P&L, profit and loss. Mhm. So, when you have an accounting system, you're able to, I know QuickBooks does it, I think the other ones do too. You're able to pull that profit and loss statement, that financial statement by customer. Yes, ma'am.
And when we're talking about by customer, you're talking about like those demographics that we went over last class, where it's like women age this to this.
No. This is like your own customer. So like, let's say, you have, because when you go to put your customer in the system, however you invoice, right? However you keep track of your invoices, customer, I don't know, 101, 201, whatever. So you're able to look at, okay, how much income you made from that customer? What did it cost you to fulfill whatever that service was, and what your profitability was on it. So
how would that relate to a regional transactional type of business versus an invoice? Because I'm not gonna have a pop-up shop or my online store, a customer giving me all of their background. I'm gonna have that they were at the small business Saturday and we bought 6 items.
Yeah.
I'm not gonna know those specifics about my customers. How would I track something like that?
Well, that goes to your customer list. Are you keeping a customer list?
No.
No? Okay. So, those little pop-ups on websites where people are like, oh, or it'll say 20% off, just give me your email, blah, blah, blah. That's a customer list. They're building their customer.
Mhm.
So a good way, I would say, if you have like a pop-up or something, try to get them to give you at least an email, something like that. And then it'll help you keep track of, actually, multiple things. One, it'll help you keep track of, possibly, demographics, not from an email, kind of thing. Won't be the best. Anyway, let's connect afterwards, and we'll go through that, okay? Any other quick questions? I want to stay on track. Okay. Yes, ma'am.
Just going back a little, if you ask a bank to loan you money, where that money in that account process is going? It's not my money, it's the bank money, and I have to make payments to the bank. Where in the books are going that?
That's so. Her question. Yes, ma'am. So, her question is, where do bank loans go in the accounting system? Is that correct? Okay. So, the principal payment is going to be under principal. So you would have an account for that under liabilities, and then you would have an interest expense. So that would fall under your income statement. And we can talk a little. I'll give my contact information, and I can help you. Okay. Any other questions? No? Okay. So next. Okay, tax reports, everyone's favorite subject. So taxes, yes, so this is important specifically if you have a business that collects sales tax. If you're doing any kind of retailing, things like that, you wanna make sure, keeping track of a tax report will help you make sure that you are collecting the sales tax and it's not, some people keep separate accounts. I suggest keeping a separate account for the sales tax. You don't have to, legally, but pulling these reports will make sure that you're not using, that
Right.
sales tax money. Because it's basically supposed to just flow through your business. Your business is a fiduciary. So you're supposed to collect it, give it to the government, not use it all. I've seen people use that money and then be upset about it. So you guys are not gonna do that. So any questions about tax reports? Yes, ma'am.
How do we find information about, like, how would we budget for those kinds of taxes?
What, depends on what kind of tax you're talking about. Are you talking about sales tax? Are you talking about IRS? Are you talking about B&O?
All
We
of
can talk,
it.
we can, it's a broad topic.
Okay,
I'm talking more about sales tax because of that flow through.
gotcha,
Yeah.
okay.
There's a, app
Yes.
on your smartphone called Washington, sales tax.
Oh,
Tell you it has all the information of each county, what percentages.
thank you.
So in the receipt that I give to the client, came how much they pay, but from what they pay already is not what paid to me. I need to deduct all of this stuff, so in the books, is other account that I have to open to put taxes there?
Yeah, so, if you're selling like, it sounds like retail or something like that, right? The money that's coming to your business that you would be taxable on would be the subtotal before tax. So you have your subtotal, like whatever you're charging them on, and then your sales tax, that's what's going to the government. And then the totals what they're actually paying. So that sales tax, you should be keeping track of that separately, because that's not part of your business, that has to go straight to the government. Does that make sense? Yes. Did we have another question over here? Yes, ma'am.
I guess I'm trying to get some clarification. So if, let's say, for example, I purchase something from a wholesale and then I have the reseller's permit. Are you talking about the reseller's tax?
No.
Okay.
Okay, so let's talk, I'm glad you brought that up, actually. So there is wholesale and then there's the consumer. So think of it as the sales tax is owed by whoever the end consumer is. Let's say you had a landscaping business, right? And you are installing sod. Well, you use that reseller permit to purchase that sod because the sod's gonna stay at the customer's property. So the customer pays the sales tax, you don't.
Okay.
Does that make it a little clearer?
Yeah.
Okay. Any other questions? Nope. Okay. Okay, so this is a summary of basically the company's business cycle. You have your detailed transactions, goes together with your chart of accounts, because that keeps it nice and organized. You use your trial balance, that worksheet that I talked about, that you can use to reconcile. If your trial balance is good to go, you can create your financial statements, which are those, actually cash flow statements missed, but there's three. There's the balance sheet, profit and loss, and cash flow statement. You can use that data for your budgeting and planning, and for your taxes and tax adjustments. And then we go back to the beginning. Any questions about this? Yes, sir.
It's a monthly cycle.
Well, it can be. It depends on what you're looking at. This is every transaction, right? This should be monthly, because you should be looking at where your business is at any particular point.
Mhm.
Taxes could be
Quarterly.
monthly, could be quarterly, could be annually, depending on what taxes we're talking about and how you file it. And budgeting That's up to you, the business owner.
Cool, thank you.
Yes, ma'am.
I'm sorry, I'm employee tax.
Employee tax, yeah. Yeah, so that's, I haven't done payroll first, yeah, I haven't done payroll, but, well, actually, no. So, the employee taxes, that would be like whenever you're doing payroll, so like, whether you're paying your people weekly, bi-weekly, whatever that is. Sorry. So, big questions. Any other?
So payroll is a whole nother genre, right?
Yes, ma'am.
Yeah.
Okay, I got sidetracked. Like, the dog would have, I just got a puppy, so I'm thinking about my puppy right now. So any other questions, anything? Yes, sir. Oh, sorry.
Yeah,
Yeah.
there are companies that will do this stuff for you.
Hello.
Yes. There are, yes, there are people that will do it for you. However.
How much did I charge?
Okay, two. So, I'm kind of on the fence about that, because as a business owner, you should at least have the education of where these numbers are coming from. And if something looks funny, you should be able to look at that and at least be able to ask questions. So a lot of business owners put their head in the sand and they don't ask any questions, and then $100,000 is missing and it's gone.
If you have the wherewithal to do it, and you can pick an expert to actually do all this mechanics, which is painful.
Yeah.
Then you actually have the time to actually.
Yeah, make money, yes, absolutely. Yeah,
Like the payroll stuff, you can use something to adjust that. I know that's one.
yeah, that's so ADP, yeah.
Have you
Absolutely.
got any idea? You know,
It depends on how many employees you have, what kind of employees, like, if you're subject to things like things vacant, things like that, like, it varies, yeah. So the next, if no one else has any questions, I'm gonna go to my car and get, business cards. So I'll have business cards. If you guys have any other questions, okay? Thank you.
Is there anyone pitching an accounting business?
Right.
Like they're like, oh yeah, I'll just do my accounting myself and you know, I'll just whatever. And wouldn't you rather make money? Like focus on making money in your business and then just leave all the headaches to somebody else.
Well, one thing to mention too, the first place winner in each category is part of the in-kind contributions that we acquired. It does include an hour consultation with a QuickBooks specialist, and Chelsea does, what's the other one, Zero or?
Zero, yeah.
Yeah,
There's, yeah.
and
There's
then a
bunch of-
follow-up meeting, so keep that in mind.
If you learn something tonight about accounting, will you shoot your hand up, please? So Brenda Lee, take something as complicated and daunting as accounting, have everybody learn at least a little something, and have them smiling at the end. Nicely done. Another round of applause. Do anything before we send them on break.
Yes, there's a poll I want you to take, except for some reason I can't get to it here. So I would go on break, and when you come back, I'll have a poll up here that I want you to take. So what it is I'm thinking of offering a small business workshop for having a business in Renton. So if you remember the form package you got at the very first kickoff, so I had reserved this room for next Wednesday. And if there's enough interest, we'll go over that forms packet, like how you fill it out, what you need if you're gonna open a business in Renton. but I want to make sure there's enough interest. I don't want to do a lot of preparation and come here if nobody shows up. So I would say take a 10-minute break and I'll put this poll up here while you guys are on break and then Sean will follow right after that.
Not your problem and your solution for that, but what you are doing for your customers. When it comes to channels, social media is painting with way too wide a brush. You are going to find a very distinct customer segment on Pinterest compared to TikTok, compared to LinkedIn, all considered social media, but you will reach a very different audience on each one. So this is about understanding your customer segment enough that you know which social media channel you are most likely to find them on. Word of mouth as a marketing channel doesn't work in the early going without a huge amount of branding and a lot of content. So as much as we want a referral-based business, that takes a lot of effort to have happen, and it's not where we're starting. We are using more traditional marketing channels. Yeah, I'll come to you in a second, I promise. If you want individual feedback on your lean canvas, Sue has already sent out individual scores. Reach out to a mentor. I'm gonna have my contact information up at the end of my presentation. You can reach out to me and I will happily give you some one-on-one guidance regarding your lean canvas or any other aspect of this pitch competition or your business. Yes, ma'am, what can I answer for you?
I'm trying to do the photo thing, and you have to install the software in order to go install, because I don't see an option.
That is outside of my lane.
No, it should be, if there's a place to enter a code, right, when you go onto that site, you enter that code, 3469449.
I think we've got some peer help. I think we're gonna get it solved. Did I see a hand up over here? Yes, ma'am?
I might have missed it, but will we get to see the actual, will you give us back our lean canvases so we can see where we got marked down?
It's not about, we didn't like make,
So how do
we
we,
didn't take a red pen to it.
how do
but-
we know
but I
what we
will-
need feedback on?
I'm good at what I do and I will be able to share with you the parts of your lean canvas you had right,
Awesome,
and the parts of your lean canvas that might need a little more work.
okay.
And please understand this, one of the biggest challenges an entrepreneur faces is getting everything that's up here out somewhere else, onto your lean canvas, into your business plan, into your marketing strategy. You know it's a good idea, but it's about taking everything up here and getting it out. It is a process.
Could you give us the solutions as to how you are very good at what you do?
That I don't do.
Yeah, I'll look at your lean canvas.
So getting it out is a very tall order, and to expect you to do it right perfectly the first time, to go from here to final draft, don't worry about that part. It is a process. And it's the editing and the refinement that dials your lean canvas in, gives you that effective springboard into your business plan. So whatever you didn't get right, don't sweat it. One last question, yes, sir.
Couple questions, so sorry.
But I'm gonna ask you to pick one.
Okay, so if we got a single score for this first like rough draft.
Mhm.
If we go to you and, you know, ask feedback, improve it, do we have a second final during our live pitch, or is that first rough draft score our score for our lean canvas?
That is your score for the lean canvas, however, and you raise an excellent point. Is it Demario? Andrew, I'm so sorry for getting that mixed up. Demario, you in here? Partner, I'm so sorry. All right, so we're gonna take your lean canvas score. We're gonna take your budget score, which will be, you have hard copy in tonight's paperwork. Plus, we're gonna send out an electronic copy to you. That's due next Tuesday. We're gonna take a score from lean canvas, a score from your budget, and a score from your pitch deck or your presentation. And the top 18 are gonna make the final pitch on April 18th. So it is a cumulative score. If you turn something in and got some score in lean canvas, I promise you, you're in. Okay, I'm gonna hold the remainder of the questions. We're gonna swap computers out real quick.
Oh, it's in there. Mhm.
The live pitch while you're doing that, is that like is that just we're pitching to ourselves, or is there like gonna be other people there? Is it public?
It's at the Renton Civic Theater, right, on April 18th, starting at 6 o'clock. It will be a full theater if I can do it, if I can help it.
Okay, so like we can invite family or like.
Well, we have tickets available and, oh, yeah. We're also selling, tickets, but I think that everyone that wants to go to the pitch in this room, I will offer them a couple of tickets for free.
Thank you.
Yeah, this is absolutely a big deal. You will be up in front of people pitching your business or your business idea. It is absolutely something to be excited about.
Well, and just one quick thing, I just got a text from Christian. She is at the mayor's state of the city address. And this workshop is mentioned in his presentation. So it's a big deal.
Oh, no, not this one. Do it. Do the applause. I will take that a step further. We have had other cities' economic development advisors and officers in these workshops. They are seeing what Renton is doing. And it's gaining buzz, not just here in the city of Renton outside the library, but along the east side. Look at you trendsetters. Nice.
Yeah,
All right, so to follow up on what Brenda Lee shared with us tonight, the accounting, that is, once you've got money in your business, how do you keep track of it? What do you do with it? All right, so now let's look at to expand or start our business. How do we bring money in? So we've talked about the whole roadmap before. If you're trying to get to Disney World and you start out driving east, you might wind up in Disney World. However, you're going to spend more in gas. It's going to take longer. You're going to miss the points along the way. Where if you just had a roadmap, if you just had a plan, you are likely to be more successful sooner. And that's what we are trying to empower you with. All right, so tonight's topic is unraveling the intricacies of component financing. That's just a fancy name for pie chart. That's all that is. So if you've got a retirement account, wherever you have your large cap, small cap, international fund, that pie chart, that asset allocation you see, I'm going to show you how having an allocation for different funding sources is actually a pretty savvy move. One Redmond acts as both, or not both, but acts as all of the economic development arm and the community foundation and the chamber for the city of Renton. That's who I work for, and that's who is bringing all of this. Whoop, that's not what we wanted. Do that again. All right, and again, my role for you. I am the hub in your wheel. I'm not going to have the answer to every question. Don't tell my daughter that. But if you come and I can't answer it for you, then the spokes I set you out on are the action items or the other mentors, the other referral partners whom I can put you in contact with, be it a lender, an intellectual property attorney, a real estate agent. And then as you make your way out to the rim where the tire is, where the rubber meets the road, remember this analogy works on a couple levels. And then as you work your way back to the hub, the more spokes we build for our wheel, the stronger it tends to be. So let me be that for you. All right, so here's what we're going to cover tonight. The ease or challenge and the risks involved with different funding sources. The value of both diversification and redundancy. That is to be spread out, but also to have more than one of some. And then finally, the three key risk points most often missed. Let's do a summary very quickly. Oh, and before I forget, I apologize. Both Brenda, Lisa, and I are going to make our PowerPoint presentations available to Sue so she can email those to you. I see you guys frantically taking notes. I see you taking pictures with your phone. Please do whatever you want to do, but I encourage you to be engaged with both the content and with what I'm able to share with you. Take as many notes as you want to, but don't feel pressure that this is your last opportunity to see this content. All right, so let's cover debt and equity. Debt is an IOU. It is an obligation to repay, and it comes with the cost of borrowing that we call interest. Equity, on the other hand, is sharing a non-diversified ownership share. That is, with your business, if you've got a partner and you're 50-50 partners, no one says, well, I got the inventory and you got the trucks. It is an undiversified share of the entire thing. Not only are you sharing in the value of the company, but you're sharing in decision-making. You're sharing in profits going forward. And you are also sharing in the risk. And we're gonna go through an exercise where we kind of break down and simplify what all of that means. So let's look at comparing debt and equity. As a cost in the long term, debt is seen as lower cost. Because once you've got your loan payments done, it's like paying off your car, and then you get to drive it for a couple years with no payment, that frees up money to do other things. So you've just increased your retained earnings, you've increased what you can take as an owner draw, you've increased your marketing budget, you've enabled yourself to hire somebody. So once you've been able to pay off that loan, it frees up all this cash to do other things. The risk is higher because you're not spreading it around. You're not sharing that risk with anyone else. It resides with you or whomever is listed on the loan if you have partners and you decide to take out a loan as a partnership. The tempo is faster. That is, comparatively speaking, even though you're probably on a 6 to 8 week calendar, start to finish, from when you fill out the loan application to when you're funded for taking out a small business loan, to bring on an equity partner actually takes a lot longer. Because you've got to sell yourself. You've got to attract someone to come to your company and say, hey, this is really good profit potential. Here's why. You should give me your money to help grow this business. So the tempo for debt tends to be a little bit faster. You've got to qualify because lenders and bankers are looking at historical numbers. They're looking at what has your revenue been for the last 3 years. They're going to want to see those financial statements that Brindley's talked about, including your business's tax returns. Now, who in here is in the startup phase? You don't have any financial statements yet. What do you think the one thing is that becomes pivotal for you to sell your business concept to a lender absent having historical documents? What's that one marketing and communication piece that you must have, Joel?
Business plan?
Absolutely. You're going to sell it on your business plan. Now, you're going to do your revenue forecast. You're going to talk about your marketing and your customer segment, what it is you do and who you do it for and why, and all the things. In large part, what they're looking for is completeness. They're not looking for accuracy. It's not about accuracy. If you tell me, Sean, I've done my revenue forecast, and in month 36, this is where I'm going to land. Guess what number you will never hit, ever. Whatever number you chose, whatever number you wrote down. But we ambition to be close. And we ambition to be close so that as we are measuring things, using what, Brenda Lee? Your financial statements. To gauge the health of your company, as you are referring to your financial statements, you're like, okay, we're in month 24. Our cash flow has been this, our profit has been this. How close are we? And is that good or bad? And what adjustments should we make based on the plan that we wrote 2 years ago? Now, things change, conditions change, but the overall overarching concept of what you're doing hasn't. So you should review your business plan at least once a year and see how close you are and make small revisions. But is that upfront effort, is that upfront planning process that's going to lead to your success more than any other single variable? Yes, ma'am.
Would they ever look at an individual's credit score to
Yep.
say, okay, that's what came to mind when you asked, was looking at your individual person and how well you keep your personal life, not just your business life, because you don't have a historical business.
Exactly. So after your business plan, they're going to look at your credit score, and they're going to look at the credit score of any partner with greater than a 20% ownership interest in your company. And here's the thing, right? You raised an excellent point. What's your first name? Candace. Right, wrong, or indifferent, they're going to look at your credit score, look at your business plan, and they're going to say, we're going to assess that this person is going to run their business with this $250,000 loan the same way they've run their personal finances for the last few years. So if you're coming down like a hot rock and you're just a mess, get that cleaned up first, then apply. Fix your credit score, fix what needs to be fixed, then apply. Get your business plan dialed in, then apply. Okay, I'll come back to you, Paul, I promise. The greatest risk here is becoming over leveraged. is taking out a loan, taking out another loan, you reached a little bit too far, and now your revenue can't even keep up with the loan payments, and becoming over leveraged is the single greatest risk when it comes to debt financing. Paul, what can I answer?
I was just getting curious, looking at personal credit, are they looking at the FICO score?
Yep. They're gonna pull credit from the three agencies, I believe, and actually, Brenda Leese, this is more your wheelhouse than mine. Is there anything you can add? Can you give us a 30-second summary on what they're gonna look at regarding your personal credit score?
Personal credit score, it's not FICO, it would probably be their preferred, credit bureau. So whether that's Equifax, Experian, or Candy. Some companies prefer one over the other, but it's a good idea, or actually, you can do annual credit report for free every year.
So are they gonna pull one, or are they gonna pull from more than one?
It depends on what they're doing.
Okay,
So if they like one of the credit agencies, then they'll pull one, some of them pull all three, but I would, my, what I see mostly is like, they'll prefer one.
and Brenda Leese, what kind of spread can you see from one bureau versus another? How much might a personal credit score waiver from number one to number three?
Kind of depends on how clean. If you stay on top of your credit, it shouldn't be more than maybe 50 or so. But you gotta stay on top of your credit so that one agency is not reporting things that the other.
So a little bit of preventive maintenance is gonna go a long way in that situation. Please don't go in blind. What an SBDC advisor can help you do is what we call pre-flight. We will write a letter for you that goes to your potential lender, and we'll say, based on the business plan, based on the revenue projections, and maybe just the executive summary part of your business plan. But we will ask them prior to pulling credit, what is your willingness to work with this client based on what it is that they want to do? So that you don't visit 5 lenders, have 4 of them pull your credit, and have 4 of them say, oh, we were never going to work with this industry anyway. So let that be one of the things we can help you do to be what we call lender ready. All right, equity, the cost, comparatively speaking, higher, because these are really tough checks to write. Every single quarter, you're writing a dividend check or sharing in the profits with someone or a couple, someone else. Yes, ma'am?
What did you say the letter was that you could write the business?
We call it pre-flight. It's like a pre-flight check. Do these things before pulling credit and give us kind of that initial litmus test. The risk is lower because you're sharing the risk with someone else. The tempo is slower because you have to pitch this and you have to sell someone on the viability and long-term profitability of your business and your business concept. You got to sell on profit potential, and the greatest risk here is loss of control. We saw it with Steve Jobs. He was ousted from the company he started. Charles Schwab named the company after himself and was still removed from the company that he started. So it can be easy to wind up losing control of your own business. So to illustrate, yes, ma'am?
A question on that, is there like, could you potentially have like a legal team that grandfathers you into your own business, so regardless of whatever happens, you cannot be removed?
Probably not. And I say that because you can't not be removed if you lose ownership control. If you wind up, however, surrendering 51% or more of your company, there's no legal document that's going to be your get out of jail free card. You're just going to lose control of your business. Okay. All right. So to illustrate the point of debt versus equity, for the next 5 minutes, let's all be 11 years old. Let's open up a lemonade stand. Now, I had a lemonade stand. Didn't look like that.
Couldn't fight all this.
There we go. That's what mine looked like. So to start this lemonade stand, we need $20. That $20 is going to buy us cups, lemons, sugar, and we've got 10. We've been prudent savers as 11-year-olds. We've got half. Mom and dad have agreed they're gonna fund the other half, and it's up to us to decide if we wanna take mom and dad on as silent partners. That is, they're there for the investment only. They're gonna invest $10, they're not gonna help us run the business. Mom and dad have their own 9 to 5. Or do we wanna take on mom and dad as debtors? That is an obligation to repay mom and dad, no matter how the lemonade stand does. Let's look at a best and the worst case scenario for each. Let's open that piggy bank. Here's our best, here's our worst case scenario. Why is that not a thumbs up? Why is that not a frowny face? That's between me and the internet. Thank you very much. All right, so equity, best case scenario, you lower your overall risk. Loss of only what you put in, which means if we take on mom and dad as investors and we put in 10 and they put in 10 and the lemonade stand doesn't work, we've only lost our 10. So it's the end of the school year, summer is starting, and let's say it's really hot outside. And we've got a public works project nearby. We have no competing lemonade stands. We got good foot traffic. This is going really well. But we took on mom and dad as partners. So at the end of every single week, whatever we made, we're sharing with mom and dad for the rest of the summer. That's a tough share. We're giving half away, but they're not actually doing any of the work. However, I will asterisk this by saying sometimes that's our only source of funding. 50% of something is way better than 100% zero. So if this is the only means we had to launch our lemonade stand, maybe this is what we do. So we're going to share in those profits. And again, 50% of something way better than 100% of nothing. Now, the antithesis of that is it's not a hot summer. There's a competing lemonade stand in the cul-de-sac next door, and they're selling otter pops. We can't keep up with that. So we get a couple of weeks into this, and we're like, not even worth it. I want my summer back. I don't even want to man the lemonade stand. They're just going to shut it down. We don't owe mom and dad their investment. They took that risk along with us. However, if we were to take on mom and dad as debtors, and we say, nope, boom, shutting it down, we got to pay mom and dad back the $10 plus the interest. Exactly, $1 a week until that's paid off. And now, because we don't have any business revenue to pay that back, we're paying mom and dad back out of our allowance. Summer just got a little bit worse because we can't afford to go to the movies with our friends. We can't afford those Red Bull drinks. Okay, this summer kind of sucks. We're going to get square with mom and dad. It is recoverable, but summer's a little bit more awful this time around. Now, comparatively speaking, it was that hot summer. We're making money hand over fist. And after the first week, boom, mom and dad, here's a crisp 10. Here's the dollar in interest. We're square. 100% ownership stays with us. We make and keep 100% of everything that the lemonade stand does going forward. But the difference is we had to make it successful to get to the point that we could have that debt be advantageous. Because we got to pay it back no matter what, even if the business doesn't work. So those are the pros and cons to a best and worst case scenario for both equity and for debt. So why does a new business or an existing business need financing in the first place? Yes, ma'am.
I just want to clarify, you mentioned in the scenario of lemonade that mom and dad could either be debtors or silent partners. Are you stating that if someone's a silent partner in a business, they'll have to repay that debt?
So if they're silent partners, it's not debt. So you raise an excellent question. Here's the difference and why I called mom and dad silent partners. They weren't there to share in the decision making. They weren't there to help staff the lemonade stand. They just made the investment. Now, if you have an actual partner, that person's going to want to protect their metaphorical $10, and they're going to want to have a say in the decision making, which means they're going to be active in the day-to-day running of your business. That's part of why you brought them in. A silent partner is exactly that. They give up decision-making authority. They just share in the profits. Most often, you're going to find someone who wants to be an active partner. So they will share in the profit, they will share in the risk, and they're also going to have the desk in the office next door. Does that help clarify?
A little bit, but I get the part that they're not going to be in the day-to-day mechanics of it.
Okay.
I just want to make sure I'm understanding that, because there's under my understanding, even they're silent, that they don't do anything, but
Right.
give you the money and wait for their money to return.
Okay.
But you're saying that they don't wait for their money to return, they just give the money up and don't say anything either? I just want to make sure I heard that.
So they make the investment
Mhm.
and then they just wait for those dividend checks to come in.
And if it doesn't succeed, then you don't have to pay them back?
You don't, because they're still equity partners. Silent or otherwise, it is still equity. They shared in the risk with us. Okay? All right, so here's some reasons why. Cash flow challenges. If you're starting a business, you are gonna have a lot of expenses just to get the business open. And then the customers are not gonna flood through your front door on day one. You have to work up to fill your capacity. Which means you got a lot of expense, but not a lot of revenue in year one. And sometimes year two. And sometimes year three. So see that fun challenge coming. So that means you have to have enough money in the bank to make good on your obligations while your revenue works to catch up and supersede your expenses. Non-incremental capital expenses. That's a fancy way for saying stuff we have to buy, but not all the time. So if we want to expand, we don't knock down one wall of our warehouse, kick it out 3 feet and build the wall again. No, we are doubling the size of our warehouse, or we're getting into a brand new lease in a much bigger warehouse. We're hiring whole people. Now, it is possible that you can outsource some things like accounting and HR and payroll and web design and pay those people not as a full-time employee, but to contract with them for what they do. And the 15 hours a week or the 5 hours a week, they might work for you. But as your business grows, you're going to have to bring full-on employees into your organization. That is a fun challenge we should all endeavor toward. Aside from hiring those full employees, or actually up to and including those full-time employees, these are big expenses that don't yet have their capacity filled. If I'm hiring an HR generalist, they're not going to be busy 40 hours a week right away. So I got to find things for them to do, and as the company grows, they're going to become busier. I don't need a tech support person who's going to be busy 40 hours a week right away. That extra delivery vehicle that we buy, that it's going to be driven half the time, and we have to add new routes to maximize its capacity. So those are non-incremental capital expenses. Yes, ma'am.
My expenses as the manager of the business is going here or could be as equity, how I can play with my time and my work inside of these debts, and may I charge my salary to this equity?
No.
No.
Nope. You've got to bring it in. This is the financing part, either with equity or with debt. You've got to bring the cash into the business, goes into the business bank account, and from there you can pay your salary from them. Don't draw it down so much that you have basically lived off the loan or lived off the finance. This is supposed to get our business to a point that we can be sustainably profitable. That's what we're shooting for. Okay. And then lengthy product development cycles. I had a client who, no lie, may have reinvented tarp technology. Yes, a tarp, the blue ones you buy at Harbor Freight, that would normally sell for about $6. He developed one that he wants to sell for like $30. Now, it's got a little bit more functionality, a little bit more innovation behind it as far as the materials used and how you can use it. But right now, he's in the concept phase. To launch this into a business, he's got to secure his production method. He's got to secure his supply chain. He's got to secure his distribution channel. He's got to market it. He's got to do all these things to build the business up underneath the concept. And he's got to pay for those things. So those lengthy product development cycles, and we see this with existing businesses as well, from New Coke to the McLean Deluxe. Companies launch new products where they spend time and invest money into launching a product that they hope will then make more money in the future. A lot of times it works. A lot of times it doesn't. So part of that is the research and development and the forecasting that goes into, should we launch New Coke or not? Guess we can all answer that question. All right, so startup costs. When I do something like this, I think I told you guys last time we were here, I don't practice, I don't rehearse. I drop a 5-hour energy into a Mountain Dew and whatever happens, happens. My startup costs are $6. For the rest of you, you have more startup costs than that. First, you got to file for your LLC or your partnership or your C Corp or however it is you're going to organize. Gotta open up your business bank accounts. If you're a food service business, holy cow, you have extra things to do. You gotta get your Washington general business license, you gotta get your city of Renton business license. And this is just for the glory of saying, look at me, I'm a business owner. You haven't actually sold anything yet. If you have a physical space, you've gotta lease it and you've gotta maybe have some tenant improvements. Your process development, all the things I mentioned about TARP technology, we have to do all these things for what we're doing. You gotta buy whatever equipment you're gonna need. You gotta have payroll and inventory, something to actually sell. You've gotta market the bejeebers out of it. And then finally, you've gotta insure it against loss. Now, some of those things can go away. If you're a service-based business, you don't have physical inventory, but all of these things we are going to have as expenses and we have to finance it some way. Because we don't have any revenue to start out, so we have to front these costs. And that's where financing comes in. And if you're an existing business and you're trying to grow and you're stuck in that, I can't grow until I get some more revenue, but I can't create more revenue until I grow. And so here I am, I'm stuck. I've been there. At some point, you've got to decide which is going to give. And are you going to bring in some level of financing, or are you going to be happy with where you're at, or change some other variable that entrepreneurs have? Most often it's the financing variable. Yes, ma'am.
So for something like licenses, not permits, but, you know, like, my business isn't up and going, I don't have startup funds yet, but I have paid for that license. Do I include that, or how does that work?
Include it where?
In my startup costs?
Absolutely.
I would, even though I already bought it.
Even if you've already incurred it, yeah, include it in your startup cost.
Okay.
It was a startup cost.
Okay.
All right, let's talk about free money. How awesome is this? I will share with you, it does not exist to the level that most entrepreneurs want it to. Now, there's a couple ways you can go about it. Who in here would like a grant? Woo, money you never got to pay back, right? All right, two things. One, hyper competitive market. Many businesses chasing very few dollars. Hyper competitive. Also, this is just my own personal lens, but if your business model is predicated on receiving money you never have to pay back, you don't have a business, you got an expensive hobby. Let us work with you. I do not give the gift of fish, I give the gift of fishing. That is, let us help you on the fundamentals of your business so you don't need a grant and then need another one next year. There are some things that we can share with you to help your business internally. One, so you understand it, so you know how to replicate it. And two, so that you can be more successful without relying on grants. The pandemic notwithstanding. All right, crowdfunding. A lot of variables have to line up for this to work. One, it's your own social network. That is, people who follow you on Twitter, people who are following you on Facebook, your Instagram followers, and whoever else. This is your network. That is, you're not getting anonymous checks from people on the East Coast you've never met before. That does not happen. Smaller dollar amounts. You're not going to raise $1 million. You're not going to raise the $250,000 that you need. Something smaller and something specific so the people who are giving know what it's going toward. We need to get our website up. We need a delivery vehicle. But something specific so that they know what they're contributing for. You got to campaign for it. You got to have some sort of carrot. A swag bag, social media mentions, something to incentivize the people who are giving to give at a slightly higher level. Friends, family, neighbors, community members, we love you guys. Thank you very much. Every $5 helps. But for everyone who donates at least $100, you get ... and then whatever the deliverable is. Because if you're trying to raise $10,000, a heck of a lot easier $100 at a time than $5 at a time. So some sort of incentive. And then finally, regulation CF or regulation crowdfunding. I see this probably once a month in different social media groups that I'm in up in Snohomish County. Someone says, I'm growing my business. I do pressure washing. I'm a mobile dog groomer. I'm a whatever. I'm selling a stake in my company for however much, right? Just like Shark Tank. But here's the thing. You can go to your family and do that because there's an implied relationship. Once you get outside of your close circle, There is a need for disclosures because what you're doing is soliciting an unregistered security. And the three-letter agencies that have oversight on our business, ranging from the Department of Revenue, the IRS, the Secretary of State, and the SEC, the Securities and Exchange Commission, they are very unforgiving when it comes to stuff like this. So there are websites that you can use if you are interested. I'll let you do the cursory web search to find them, but be wary of Reg CF and selling or soliciting unregistered securities. And then finally, this has been part of this pitch deck for a while. It's not just for this, but pitch competitions. And here's why I like pitch competitions better than grants. When I mentor high school students, I tell them, I go, look, if you can invest a Saturday, 8 hours, and you research and you apply for scholarships, and you hit on one that pays $1,000. That's $125 an hour. Would you do that? Shoot, yeah, I would. I'm making 19 now. Great, that is a worthwhile investment of your time. When it comes to grants, again, hyper competitive, many businesses chasing very few dollars. You could spend a month of Sundays researching and applying for and come up empty. That is time spent that you could have spent growing your business in another way. However, pitch competitions, there is a deliverable outside of the prize. We had 71 original registrants, and Sue and I, our focus is on the 68 non-winners. Because your deliverable is, I didn't win, but I still learned enough to launch or grow my business. And that is what we are trying to empower you with. So there is a deliverable far stronger than just the prize money. And everybody in this room is eligible for that prize.
Where did the carrot come from?
The carrot is the incentive, the swag bag or the something special people get if they contribute at a slightly higher level. Excellent clarification question, thank you. All right. Equity. Equity we can break down into a couple different flavors. The first one is personal funds. Actually, let's start from the bottom. We covered crowdfunding. Let's talk about venture capital and angel investors. And a little bit like the name sounds, an angel investor will come out of the heavens, I'll come in 2 minutes, I promise, and say, I'll help you save your company. They tend to come in a little bit later when you're in a state of desperation. Venture capitalists tend to come in a little bit more toward the beginning of the process. And just like Shark Tank, you will make a pitch or they will make an offer and say, I'm willing to invest $150,000 for this percentage ownership in your company. Here's the thing. They're not working with just you. They are working with a pool of small businesses or small business startups, and they are trying to achieve a target rate of return. They know mathematically the 20 businesses they're working with are not all going to succeed. You are one of the 16 who will succeed. However, that target rate of return they're trying to achieve on 20 now falls to the shoulders of the 16, one of which you are a part of. So if the fair market value of your business is a 15% ownership stake for $100,000, they're going to offer you the $100,000 for 25%. And you might negotiate them down to 22. They're going to take more than a fair market value of your business, in part because they can. They know that if you're seeking out a venture capitalist or an angel investor, you are in a spot where you've exhausted or don't qualify for other means of financing. Now, remember what I said about the lemonade stand. 50% of something is better than 100% of zero. However, this is going to be a tough decision that every entrepreneur will have to make when faced with that situation. All right, so that's VCs and angels. A partnership is just a bunch of people all working together. They might join you because you're a group of friends. You served in the Navy together. We were in college together. This is my cousin. This is my ex-roommate, whatever. Now, there could be value beyond the actual investment. That is, if you are great at production, but you can't market your way out of a wet paper sack, and they're really great at marketing, maybe that is a very symbiotic relationship where you want to bring them in. Or maybe you bring someone in that's got the industry expertise and the contacts and years of experience that will accelerate your learning curve faster than you could on your own and make you more successful faster. That might be worth it. So the benefit beyond the investment. And then we got our personal funds. Now, as Americans, we tend to hold our net worth in two places. What's one? Homes.
Realistic.
Our home equity, our home equity is one. What's the other? Nope. It's that retirement account. Yep, exactly. Now, this might be some of the easiest money to get to. It doesn't mean that's what we should do. Let me pull that apart a little bit. One of the greatest risks I talked about was becoming over leveraged. So way before you need it, you can access your home equity by taking out a home equity line of credit. If you haven't actually used it, that is, you just qualify for it, it's sitting there open and you have access to it, it doesn't actually cost you anything. Then when you need it, you write a check against your home equity into the business bank account, poof, you're funded. Son of a gun, that was easy. Sunday, Monster Jam.
Yeah.
Right. So before you need it, that is well before you launch your business. Banker, are there any bankers in here? Okay, good. Bankers are notorious for giving you money when you don't need it and saying no when you do. So you will apply for and qualify for your home equity line of credit way before you need it. Remember when we talked about the worst case scenario with our lemonade stand? And if the business has to close, right? Now we have just given ourselves a greater personal liability with owing a monthly payment to the bank for our home equity loan. And we don't have any business revenue on which we can take our owner's draw. So full on bankruptcy notwithstanding, what's a worst case scenario in this situation? Potential foreclosure, right? Now, if you miss a payment on your home equity line of credit, is your bank gonna come in and put the yellow caution tape across your front door? No. However, have I seen bad things happen to good people because they became over leveraged? Yep, sure have. So just guard against that. Now, the other place we tend to hold it is in our retirement accounts. And just to keep the numbers nice and round, you're gonna get your, how are we doing? Okay, you're gonna get your retirement account statement. It says $100,000 and you say to your significant other, here's our startup money. You call your stockbroker, you call your whoever, and you say, liquidate everything, send me a check. What will the check actually be for? What amount will you see and have mailed to you? Well, show, I'm here, lots of show hands. Yes, ma'am.
It'll be like 75 at best. They take up all the fifty.
Lower, excellent first guess. 70 is the right answer. Here's why. Prior to the age of 59.5, 10% early withdrawal penalty that you pay to the IRS and never get back. 20% mandatory federal income tax withholding because these funds have not been taxed yet. Here's the kicker. When it comes to the following April 15th and your tax filing deadline, if your effective tax rate is greater than 20%, you might owe even a little bit more. So either A, you got to scramble and come up with those funds. That's a tough check to write. Or you got to hold a little bit extra out, which means the 70 you got now may only be 65 because you put $50,000 in kind of this emergency fund. So your 100,000 shrinks to 65. A third of that has evaporated. Now, you might take that 65,000, start your business and grow into a $5 million empire, in which case savvy move, good on you. Let me take you out for a steak dinner. However, just like the infomercials we see at night, the little disclaimer across the bottom, results not typical. So our investment has to do two things. One, it's got to grow the business so that it can sustain our lifestyle and do all the things we wanted to do and replace the amount that you took out originally. So there's more pressure and the risk that in a few decades, that is when you need it the most during your retirement years, that nest egg is gone and has not been replenished. So please understand the risks involved when it comes to your home equity and your retirement savings. I'm going to hold questions. I want to make sure that we can get through this. So give me 5 more minutes and if there's time for Q&A, I will happily answer any questions. All right, debt. An institutional loan, the SBA will not lend you money. They are not a direct lender. However, much like the VA works with veterans and home loans, they will help guarantee the loan. So your typical big bank, regional bank, community bank, what we call a CDFI, Community Development Financial Institution, will give a startup business that second loan. That is what the SBA can do. A personal loan from someone else, and that if you are borrowing from either the business owner, if you're purchasing a business, or from family, have everything spelled out. Terms, expectations, the whole 9 yards, because if one thing goes cattywampus, every Thanksgiving from here in perpetuity is now changed. Okay, so be very careful with that, please. Credit cards, vendor financing. Let's say we want to start a bike shop. We want the high-end mountain bikes in our bike shop, but we can't pay to have them in right away because our cash is kind of light. Well, what the vendor might do is say, okay, we'll give you the bikes now, and you don't have to take out another loan. You just finance directly through us. We're going to charge you a little bit of interest because we'd rather just have cash up front, but we will finance it to put our bikes in your shop. That's vendor financing. And then finally, unearned income. If you Google hard enough, you will find companies that will make loans to you based on either contracts or accounts receivable. These can be very predatory. These can have very high interest rates. And it is basically a Band-Aid on a sucking chest wound that you put on with super glue. And by the time you rip the Band-Aid off, you've just made it worse. I encourage you to avoid those at all costs. A little planning ahead of time will help you do that. What do you think the 1 and 2 sources of funding for startups? What do you think the 1 and 2 sources for startup fundings for are? What's that? Nope, it's not a loan. Number 1 is personal funds. Number two is credit cards. All right, I'm gonna let you read through this. We're gonna say questions. I'll let you read through this real quick because you can read faster than I can talk, even on my best day. Okay, I will back up to that slide if there are questions when we have time. Ease or challenge, total cost. We talked about the risks, especially involved with different funding sources. The value, diversification, and redundancy. That is, we're not going to take everything out of the 401k. We're not going to leverage everything on the home equity line of credit. We're going to take a little bit from here, a little bit from here, and a little bit from our personal savings, and we're going to cash in some stocks. And then our safety net, that is our plan B, is going to be this funding source. And then our absolute drop dead safety net is going to be this funding source. And then if we get to that point and we exhaust the cash, we're going to pat ourselves on the back and understand that we're going to stop throwing good money after bad, congratulate ourselves for giving it the college try, and not run our personal network down to zero pursuing this. And again, before we get to that point, we can help with a little bit of planning and help you avoid that. 3 key risk points most often missed. I talked about becoming over leveraged with your retirement account, with your home equity, and the other one is just flat out failing to plan. And that might sound like, oh, that's kind of a cheap one. No, absolutely. Failing to plan is going to be your undoing more than almost any other variable. And then finally, risk mitigation. There is blind risk and there's calculated risk, and it's all blind risk until you actually do the math. It's all blind risk until you do the math. All right, here's my contact information. Sue, are we at the end, or do I have 60 seconds? I've got a nod from Christian in the back. All right, we're gonna wrap it. Here's the thing: if we did not get to your question tonight, email me. If it's super simple and quick, I'll respond. If it requires a little bit more of a deep dive, I will happily share with you how you can register for no cost small business advising, and I will help you that way. All right, Sue, who's taking over? You or Christian coming up?
They're gonna explain that now. Can you explain the homework a little bit?
Well, if you take your feedback form out of that packet, fill it out, and look at it.